So we're going to be talking about flipping houses. This is, we've been flipping houses for many years now. We've renovated a lot of houses. The pandemic made everybody feel like they were geniuses in this business, you know, because they would buy a property, sell a property and make money. And they're like, oh, I'm so good at this. It's like, bro, everybody's making money. Like, trust me, you're not special. What was special was pre-pandemic, where it's like you needed to analyze deals. You need to understand where you're buying, why you're buying, how you're managing your rehabs. Are you doing good work? Are you putting out good quality? And that's the thing that's the market that we got into, a market where you needed to know what a deal even looked like. And in the past couple of years, again, people got very lazy and we're starting to see them struggle. I'm getting calls from a lot of investors that they're like, I can't find deals. I just lost money. My rehab went over budget. This thing happened. It didn't sell for this price. And I'm like, welcome to real estate. You know, like, this is what the market should be. So it gets us excited because now it takes actual knowledge to make money in this business. And what we're seeing is not many people want to dedicate that kind of time to gather that level of knowledge. So real quick, my name is John Barbera. This is my business partner, John Barr, that's hiding over here in the corner for whatever reason. Come on. We're together. They get both halves. So he's the hairier side of Prime Homes, as you can tell. And we started off with wholesaling houses, and we started with marketing, doing all those things. We never liked wholesaling. Till this day, I still don't like wholesaling, but I respect the opportunity, the value that wholesaling provides. Because as real estate investors, when the pandemic happened, one of the biggest things we learned is we don't generate our own deals. And because we didn't generate our own deals, we were actually a victim of the market during the last half of 2020 because our deal flow went to nothing. When we were buying from wholesalers, agents, referrals, all of a sudden they were getting 40, 50 grand more than what we were paying by just selling it to all these new buyers that were coming in the market. So we completely lost out. So we learned the value of generating your own deals and having that a part of your business. And then we got into flipping, we owned rentals, we did new builds. So within all this, we've learned quite a bit of things that, you know, we're hoping to share with you in this. And please feel free to ask any questions at any time. All right, we're gonna try to move quickly because I try to keep it under an hour so then we can get back to networking. But if you have any questions or anything that you guys are not making sense, please let us know. Again, this is John Barr. He's the
broker, associate broker.
There you go. Associate broker for Stepstone Realty. So, you know, he's a big, important guy. But yeah, I mean, he handles all of our projects, deals with the contractors, what he likes to call adult babysitting, which it really is. So you're going to hear a lot about that. So this is the agenda for today. We're going to cover the mindset you need, changes that we've seen in the market, whether or not you should buy, rehab, pre-list, and then offer. So we're going to try to move pretty quick through all these things. So first with mindset is you got to have a long-term view of real estate. What does a long-term view of real estate mean? Is don't look at this, you know, if you don't get this deal right now, you're out of business. You understand? Because what ends up happening with a lot of people is you end up becoming a motivated buyer. A motivated buyer buys shitty deals. And how do I know this? We were motivated buyers. There were times that we didn't have deals. We're like, shit, we need a deal. And we bought a deal, and every time we bought those deals, they were the worst deals we ever bought. Made us no freaking money and wasted a shit ton of our time.
You lose twice when you do that. You lose money and you lose time, a lot of time.
And it never helped our business. It was never like, oh, but if we didn't do that deal, we'd be out of business. It never works that way. You're not going to be out of business because another deal's going to come around. You understand? So you can't be a motivated buyer because all you're going to do is you're going to end up risking capital and time, which is the worst part. We've done 22, 23-month flips, and we've been building a house, 3 houses for the last 3 years. The same 3 houses. That is just time you don't get back. You understand? When you accumulate that time into actual income-producing activities, we could have been making a lot more money doing other things than managing those damn projects, right? So don't be a motivated buyer just because you don't have a deal. I'd rather you not have a deal than have a bad deal. So you don't need that next deal, all right? Again, it's not a necessity. You don't need that next deal. Even though if you're saying, I'm a flipper, I need my deal, I need the deal. Yes, but still be smart about how you're buying it. And this is the funniest one. You're not going to learn better on your own. For all of you that think like, no, John, I need to get into this flip myself, by myself, because I learn better that way. That's 100% bullshit, all right? Because you might make money, but you're not going to understand that you could have made more. And you're not even going to understand why you even made that money. You think you're smart. Maybe you were lucky. You know, you made 15 grand. Maybe you could have made 40. The only way you're going to know that is by working with somebody that knows what the hell they're doing. So when you get into real estate, partner with people that have done it successfully. And what does that look like? If I'm flipping a house in the historic district, which I won't, but if I'm flipping a house in the historic district, I'm going to find an investor to partner with that flips houses in the historic districts successfully. I'm not going to get an investor that flips newer homes, because an investor that flips newer homes does not know how to flip a historic home, and vice versa. An investor that knows how to only flip historic homes doesn't know how to flip a newer home. I've seen this time and time again, where we've had investors that come from Austin with all these fancy houses and historic and everything, try to flip a newer home in San Antonio, and they completely lose their ass, right? Because they overspend, they put the subway tiles everywhere, they put the barn doors, and then it's like, well, I was supposed to sell it for 50 grand more. It's like, bro, the market doesn't call for that. Run your comps, right? So the only way you're gonna know that is you partner with people that know. And this does not mean contractors. Don't partner with contractors, ever. Just stop. No. We're investors first, right? Partner with investors. Contractors, it's just, they should know how to do the job. That's about it. They don't know what job needs to get done. That's an investor's job. The investor is going to determine what job needs to get done, what's going to bring in the most return. You understand? Contractors don't understand that. And this is not a knock on contractors at all. I'm just saying, don't be so silly to think that a contractor is going to help you flip a house. It doesn't work out that way.
You know, the favorite term of the investor-friendly contractor, it's like, they don't exist.
Yes, investor-friendly contractors. So some changes that we've seen in the market is buyers are starting to have more options than they were during the pandemic, right? We're seeing a lot more properties come out. We're seeing a lot more people selling their homes. Yes, sir?
What about contractors that flip houses?
So there'll be investors then that are also contractors, right? So that would work. If they're contractors that they flip houses successfully, because we've met contractors that flip houses that lost over 6 houses to our hard money lenders because they weren't successful, right? So the point is successful, right? That's, you know, and you want a track record. Not a one-year track record, right? You want pre-pandemic track record. Because again, the last couple of years, everybody was a genius. You understand? So it wasn't hard to make money in the last few years. I mean, we were taking on deals that's like, hey, you know, we're hoping to make 20, 25 grand. We finished the flip and it was like 45. We knew we weren't geniuses. We knew it was the market. It's like, oh, awesome. Extra 20 grand. Thank you.
So we're big on making sure that it makes sense today in today's market. Like if I bought a house and sold it today and made money today, then we'll do the deal. We know a guy out of Dallas that he built his whole business around appreciation. And because he got into it in 2020 and then started ramping up and was just paying whatever wholesalers wanted, bought a whole bunch of houses. And when that market turned last year, he was seeing just red across everything because his whole thing was, he's like, well, by the time I bought it, it usually went up and the deal made money then. I was like, can't do that forever. So we're big into the fundamentals of buy today, sell today. And then if it makes money today, then go ahead and do the deal. But don't buy it and say, oh, the value will be more in 6 months when I'm done, because that's not a guarantee.
Yeah, you can't bet on appreciation. Nobody can, not even buy and hold investors. If you buy and hold, you're buying it for cash flow. If you buy for appreciation, you're gambling, right? Because it may not appreciate. We might have another black swan event or something happens that it's not like pandemic levels, it's worse, right? And all of a sudden, real estate goes the other direction. So you can't, you know, we don't want you speculating. There's also less buyers in the market right now. So buyers have more options because there's also less of them, right? There's a lot of buyers that right now can't qualify for loans because they can't pay those mortgages, those interest rates. Interest rates went up, taxes went up, insurance went up. It's making it harder for a lot of people to be able to qualify for a loan. This creates less buyers in the market, and because you have less buyers in the market, the buyers that are in the market are pickier with what it is that they're buying.
So one thing I discovered last year when I started looking at this stuff was like how much interest rates affect payments. So you really think of it like people don't buy houses for the price. They don't care about the price. They buy for the payment. That's what they're trying to solve to, is the payment. Just like when you go to buy a car. So for every 1% a mortgage rate goes up, the payment on that mortgage goes up 12%. So we went from 3 to 7. That's 4%. It's 48% more expensive on the mortgage payment itself in the house. So everyone's like saying, oh, houses were up 20%, and they were. Well, mortgage payments went up 48% in just 4, 5, 6 months. So that's why it knocked a ton of buyers out, because now it's high prices and high interest rates really killing a lot of people, because it just makes it just so expensive to buy houses. We sold one last summer when I saw what their payment was going to be on this like $230,000 house, $250. It was like $2,500 a month. And I was just like, God, I was like, you can rent this thing for like maybe $1,600. And it's like, you're paying $2,500 a month for this house. And it was an older house. It's like, they come with more problems long term. Best of luck. That's why I can't do traditional agency when it comes to buying and selling, because I couldn't tell somebody not to do that. But yeah, so just keep that in mind when interest rates and payments and like what that really affects the market.
So say those numbers again.
For every 1% a mortgage rate goes up, it makes the payment on the loan, and excluding taxes and insurance, but just the interest, the PI goes up 12%. So $1,000 payment goes up to $1,120. So you think that over time. So like when it went up, $1,000 payment went up to $1,480 from basically April to August last year. But it's vice versa. When rates go down, you can understand how the economics of buying and selling real estate kind of work.
And then affordability, it's always been a thing, right? We need to be able to afford things. It's become even more of a thing. Gas prices have gone up, groceries have gone up. Affordability has become a massive issue. This is why, I don't know if you guys have heard it or you've seen it somewhere, but like everybody's talking about that we're becoming a renter nation, right? Because affordability, like he said, that mortgage was $2,500 when that same house in those conditions rents for $1,600. Why would you pay $2,500? Right? Like as far as affordability goes, it makes more sense to rent than it does to own a house. This is why when we analyze properties, we're trying to analyze houses that are in the affordable price range for the mass market. We don't want to be in those, kind of niche kind of zones of real estate. And then there you go. See, I can see. That's why I made a note of it. So we look at days on market when we analyze a property. When we get a property that we're thinking about buying and everything like that, we're looking on days on market in that particular area, because our biggest thing is speed of market. Like how fast can we put this property on the market and it sells? Because we've seen months of inventory go way up after the pandemic was over, right? So that matters because that's going to determine your holding costs. That's going to determine everything that you're going to be doing and the type of rehab that you're going to be doing on this property. So we're looking at months of inventory. We're looking days on market. The length of the rehab matters a lot. We are no longer taking rehabs over $50,000 because the longer we stay on a rehab, the bigger the chances that the market can shift again. Something can happen, right? This is why we don't do historic homes anymore, why we don't want to do new construction, right? Because those things, the speed that you have on those, it takes too long to renovate those houses. And that kind of length, it gets to a point where it's like, unless I'm buying this at a stupid low discount, there's too much risk in a deal like that. There's just way too much risk. Labor needed, this has been another big factor on what we determine the type of rehab, is the labor needed. Labor's always been hard for us. It's always been freaking hard, especially more like specialized labor, right? You need more of a carpenter, things like that. It's harder to find that kind of labor. So if you're looking at a house that you need to tear down a wall, you need to do an addition, you need to do more complicated things.
Anything structural, basically.
Yeah, anything structural is like we try to stay away from those because the contractors that we need to find are really hard to find. You know, dependable contractors for things like that, they're very hard to find. So we rather not have to deal with those types of renovations. We've done them in the past, and that's why we don't want to do them. You know, we've learned that that's not what we want to do. Doesn't mean you shouldn't, it's just things to take into consideration. If you take on houses that need way too much work and specialty work, like if you take a historic home, now your tile work needs to be really good because you're maybe dealing with some funky looking tile for that mid-century historic home. You're dealing with some different types of molding, different types of custom cabinets. Now the quality of labor needs to be much higher, right? You can't have the same guy that will renovate a 1980 built house renovate your historic home because the skill set doesn't always translate. You understand? And it's completely different. This is why when John manages the project, he calls it adult babysitting because it's just being there, making sure that they can do the job that they're being hired to do. If not, you got to let them go. Yes, sir.
Have you had any success figuring out where that labor went to? Because these people haven't all died, you know, I don't think, or moved. Where are they? Why can we not find that labor out there?
This is no stats or data on my end. This is just a pure hunch. People got lazier and they figured out how to live with less. Because even with our contractors, we taught them, they have trouble finding labor too. And it's like, even like before you used to, I was an illegal immigrant and I was never picky on the work I got. Now it's like, oh, you got to provide me with lunch. You got to pick me up. You got to give me the tools and I charge $250 a day. Like, shit, I want to be illegal nowadays. You know, back then it was like, you're really illegal. Like you got paid shit and you can put up with it.
And that's no joke. Where like I talked to my.
Exactly. That's what I'm saying. I was like, wait, for like sweeping and shit, you're getting paid that much? I'm like, yeah, I'll be illegal again.
That's no joke. Because one of our foundation contractors, he was having problems finding people to like just dig holes. And I asked him about like, what about that guys at corner Home Depot? And he's like, worthless. And so they want to be picked up at 7. You got to give them breakfast. They want an hour-long lunch, which you have to provide, and they want to have a 6-pack of beer by 3 o'clock and drop back off here by 4. And he's like, and they're no good at better than just pushing brooms. And at the end, they want $200, $250 a day. I was like,
and they're sensitive. You better not tell them to get to work because they'll get offended. Like, man, illegals have it nice.